Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Now, so kind of to review the math on the idea of a debit spread is that we, let's say, have a $1 profit potential, but we paid 55 cents for that spread. That means that we have 45-cent profit potential on that, or basically with a 55-cent cost and a 45-cent profit, you're more or less talking about 80-90% returns. If you end up being right on the risk. Now, the break even is obviously at 21.5, like we calculated, and the max loss is at 55 cents. So more or less, you think of it that you're starting off at 21.25 on the stock, but you have the upside. You basically have the 45-cent upside so long as that stock rallies there. Now, the one thing I want to just emphasize before I go to the next example of a debit spread is just the emphasis that if you're doing this on any stock or ETF, it doesn't matter which one. If let's say you know that the implied volatility on this particular stock is much higher today than it normally is, then immediately the first thing that needs to pop in your head is that instead of just buying the call or the put, you want to consider doing the actual a debit spread. Because what happens is that if let's say the volatility index, which would be a good gauge as the volatility of the whole market, if that volatility index goes from 30% down to 20%, the VIX goes from 30 down to 20. If you just owned a call option on its own, let's say this 80-cent call option that we talked about earlier, let's just say that we only bought that April 21 call for 80 cents. If there was a volatility contraction, you lost some time decay, even if that natural gas ETF was trading at 21.25 a week or two later, if that volatility contracted, you might find that option is trading for 60 cents instead not at 80 cents, and you're already down 25% on the call just because of the volatility contraction and a little bit of time decay. By doing the actual spread, what's happening is that you might have lost 20 cents in volatility contraction, but you may have made 15 cents on the volatility contraction on the call, which you collected 25 cents for. It might only be asking 10 cents at the time. And therefore what happens is that you've actually removed the volatility out of the equation, or at least mitigated or marginalized the effect that volatility has on your option position. Now, the other opposite way of doing that is to actually do it with puts by doing what's called a bear put spread. Now, I only have the one slide on this. I didn't actually do an example because, in fact, a bear put spread has the exact same logic behind it as the bull call spread. It's just we're doing with put options. So here you must have a bearish outlook, which is an anticipation that the market is going to decline or that ETF was going lower. Now, we would buy a put option, the one that you feel that was going to best participate in that. But if you feel that put option is too expensive, you offset the cost of that expensive put by selling a lower strike put option at for the same expiration. The reason I have a same expiration written there is because once you go to different expirations, it becomes a calendar spread, and it's a whole different example. So if you just want to do a classic bear put or bull call spread, which is a debit spread, that you would use the same expiration month for that example. And in terms of that, and I've seen a number of people even offset it, like in those calendar ones where they would offset it, the selling of a shorter term one, because that's where the volatility moves are in many cases the most predominant. Now, so, and just like someone online here, didn't have a name there, but was talking about the idea of doing a credit spread. Well, now we're going to cover the idea of selling that volatility and collecting a credit for actually executing that strategy. Now, credit spreads are different than debit spreads. Debit spreads are directional plays, which is that you actually need the stock to rally in your favor in order to make the profit on the trade. And so you're actually a market timer under those circumstances. You're actually trying to forecast that the stock is, or the ETF is actually going to move that direction, and that you want to profit from that. Now, the credit spreads are a little bit different. When you sell a credit spread, so long as you can actually profit on those, even if a stock is actually staying the same. We'll talk about that in a second. Now, what's the opposite on credit spreads is that if you're bullish, you would do put credit spread, and if you're bearish, you would do a call credit spread, because it's now the opposite, where we're actually selling the closer to this at the money strike to collect a premium. And so what happens now is that if we, let's say, believe that this natural gas ETF was going to either stay the same or go up, we would sell a bull put spread to try to profit from that. And we're going to do an example of how we could use that ETF to do that bull put spread. In the same regards, a bear call spread is when you think that the stock is actually going to go down and therefore never get up to those price levels. And so long as you sell the bear call spread at the right levels, you actually can profit for the fact that the stock never goes to that level. Now, when we're talking about credit spreads, what we want to discuss here is the idea of selling big premium options for credit, and we're putting time decay in our favor. The longer we hold a credit spread, the faster the bigger option or the premium we got is decaying at a faster rate. And we can profit from that even if the stock stays the same at the same price. This is actually very important, because this is why credit spreads are very powerful, is the fact that you don't actually have to be right. You just can't actually be wrong. And a lot of people believe that stocks only either go up or down, but they actually can be in one of three places. They can go up, they can stay the same, or they can go down. And most people take for granted the fact that over 2-3 weeks they suddenly look back and the stock is at the same price that they actually were at 3 weeks earlier. And that time decay is actually burning away. And so long as you think that stocks have reached certain levels that make sense, what you end up finding is that that you're making money from your directional play, even though the stock isn't moving. So let's just say a bull put spread. Here I said the outlook was actually bullish, but let me restate that. It's bullish to neutral. In the end, as long as you're just not bearish on the stock is the most important thing for a bull put spread. Now, a bull put spread, we sell a put option and receive a credit for doing so. We'll do an example of that, so I'm not going to go into much more detail on that. And then we buy a cheaper put option at a lower strike price to hedge the risk. The cost is obviously of the cheaper put option is subtracted from the credit received, and so long as the stock stays above that strike price, you get to keep the credit and you are profitable. Now, the emphasis here, why is a bull put spread effective? It's effective particularly for small traders. If you're trading a $10,000-$15,000 account rather than trading a $100,000 or $200,000 or a couple $1,000,000 account, you don't have the ability to do outright option writing. At least you have only marginal ability to do that. More often than not, the margin requirements of doing, let's say, naked calls or puts, which is a strategy which I'm an advocate for so long as you're a trained trader that actually knows what they're doing or what they want out of a stock. Very effective strategies, but a lot of times smaller accounts cannot capitalize on those opportunities. And so under those circumstances, if someone, let's say, has a $10,000 account at a local, at their favorite little broker, what happens is that if they wanted to, let's say, sell a bunch of put options, they would be deemed naked, and therefore would soak up a massive amount of margin. Now let's just look at an example how we could receive a credit and yet not have to worry about that margin burden. So in this example here, we're going to go back to that natural gas ETF, the FCG, and it's at the same price it was when I was doing the examples at $21.25. Now, to do a bull put credit spread, what we're doing here is we're selling, let's say, an April $21 strike put. And let's say that's right now bidding 60 cents. At the time, it was roughly, give or take, around there. And now, when we sell that put, at the same time, what we're doing is we're buying one April $19 put. Now, that $19 put is, let's say, asking 25 cents. Now, why is that? If we, let's say, just opened the $21 put, it may have required us to even keep let's say, for every $2,000 position, you probably would have to maintain, give or take, around $500, $600, $700 in terms of margin in order to keep that position open, and that's even being fully margined. So if an investor wanted to, let's say, in a small account, open up 10 contracts of just selling the put option naked, they would suddenly find themselves having soaked up the entire $10,000 account just to meet the margin requirements of having sold that. While if somebody wanted to just open and profit from this but not have to use up all their margin, they could at the same time turn around and buy an April $19 put. In this situation, it was 25 cents on the asking price at the time, and therefore receive a 35-cent net credit. And now that 35-cent net credit is income. That's real money. And so long as that natural gas ETF doesn't drop below 21, every day that 35-cent net credit is time decaying, and you get to keep it, even if the ETF doesn't really do anything and stays near this 21.50 area, even for the next 3-4 weeks. You sit there and are collecting the profit as the time decay is working in your favor. Now, the benefit, though, is the margin requirement is actually only the net difference. So I'll talk about the margin just on the next slide here. So on the next slide, we have a situation where the net difference between the strike prices was $2. So we bought the 21. So we sold the 21 strike put, and then we bought the $19 strike put to offset it. Now, for that, we collected 35-cent credit. So now once we that $350 per or $35 per contract comes in the account, and in doing so, it's $1.65 is the capital requirement. So you only needed to maintain a margin requirement of $165 per combination of one contract long short. You only had to keep $1.65, while someone that was naked to put might have had to keep $400, $500, $600 margin there. You only needed to put $165. So it allowed you to actually, for a smaller trader, to leverage your money in that process, and therefore create on a risk-adjusted basis a 21% return, so long as that ETF never drops. Well, it could temporarily drop below 21, but so long as it closes above $21 come in expiration, you get to keep the 21% return. Now think about this for a second. Even if the stock dropped from 21 and a quarter, the price where it was when we talked about this example, if it dropped 25 cents over the 4 weeks and closed at $21, you actually still made 21% return. In fact, even if the stock works slightly against you, it doesn't hurt you so long as it stays above the $21 strike. So in this example, the risk graph, you can see the loss was limited to the $1.65, which was the net leftover amount after you've received your credit, and your maximum profit though was limited to that 35 cents, and so you make the 35-cent profit and off that price there. Now, again, I just see some questions coming in. We can certainly, again, address a number of these questions. I want to make sure in the next 15 minutes I cover the callers, and then once I get all the slides done, I'll be happy to address any questions. Now, the opposite, obviously, is to do what's called a bear call spread. And a bear call spread has an outlook that is bearish on the market. Or again, neutral to bearish. You just simply cannot believe that the stock is actually going higher. Even if it stays the same or goes down, that's perfectly fine. So you sell a call option and receive a credit. Now, you buy a cheaper call option at the higher strike price to hedge that risk. So again, you sell a call. So in this example, let's say you were outright bearish on natural gas ETF, and you said, I'm selling the $22 call, and I'm willing to be, under normal circumstances, you could even be naked that call option. But if the margin requirement is too high, you could always buy a more expensive, a cheaper, higher strike call option, let's say a $23 or $24 strike call option, reduce the cost of that, and therefore you subtract it from the net amount. And so long as that stock or ETF stays below the strike price, you get to keep your credit. So it's just the opposite. It's just now you're bearish on your outlook, and so you're going to do the spread with call options instead of put options. By the way, there's lots of great ways to learn about these different spreads. Even if you go to our option source website, we have a strategy screener in there where we describe all of this in there, and courtesy of the Options Industry Council, we also have the strategy simulator in there, and you can actually simulate these strategies using some of ISE's ETFs and see how it would actually work out if you open some of these different strategies in your account. The last thing I want to talk about is the collar strategy, and the reason I want to talk about the collar strategy is that a lot of times people look at ETFs and they want to buy a protective put. And now, a protective put is a very valuable thing because let's say you actually physically own the shares of the ETF, and let's say that you bought those shares, let's say that natural gas ETF, even back at $19 6 months ago or 5 months ago, and now it's trading at 21 and change, $22, and you wanted to, let's say, remove the downside risk and lock in your profits. You want to buy a protective put. But the problem is that put protection might be too expensive for you, particularly if you're a larger investor. And let's say you have a couple $100,000 or a couple $1 million in this ETF. Well, now buying put protection becomes a very expensive proposition. And so what happens is one can reduce the cost of that protection by doing a covered call. So the way a collar strategy works, it's also known as a hedge wrap. We create a position that limits the downside risk, but also limits the upside. ideal for existing positions that have already moved in your favor and that have only a marginal upside left on the stock. And it involves really a combination of two strategies. So the way it's broken down, the first component is a covered call. So now think about it, we physically own the shares of that ETF. So we now, let's say, have 1,000 shares of this, let's say, natural gas ETF in this example, let's just say. And now what we do is we collect an income for selling a covered call. And we generate a cash flow and by capping the upside potential. Then what we do is from the income that we made, the second component is we buy a protective put. Remember, I use the word protective in front of the word put, but understand we're just buying a put. There's only one type of a put out there, and that's just a put option. What makes it a protective put is that we're buying the put at the same time as actually owning the shares. What happens is that when we own the actual shares of the ETF and we buy the put, if we ever chose to exercise the put, we can actually exercise the put to sell the shares at the specific strike price of that put option. And so what happens is we use the proceeds of the income from the covered call to actually buy the put protection. It very rarely works out to being a wash where one equals the other. More often than not, either the put is more expensive or the call gets you a bigger premium. The point is that we're using the option to actually profit from it. So when do we use this strategy? When we're optimistic about the investment, but we have short-term concerns on the stock. The concerns can be technical, they could be fundamental, but in the end, if you believe that there was a risk to a market correction or something of that nature on the downside, one can utilize the strategy to profit from their directional call. Now, in this example, we're going to look at natural gas ETF. It's been the example we've been using throughout today's entire presentation. So here's a chart on that natural gas ETF. There's been certainly natural gas has been consolidating as all the energy stocks have all been coming off. And you can see a little bit of a high on that ETF, and it's now selling off. Let's say one felt that there was a chance that this ETF could continue to correct on the downside. As it's moving downwards throughout that process, let's say we wanted to buy $21 protection, but at the same regards, we wanted to leave upside, let's say up to $23 on the ETF. So now what we do is we remove all the risk of the downside below $21 and leave upside on the stock to 23. So let's create a collar that does that. So in this situation, the natural gas ETF was at $21.25. Let's say we actually want to even just buy it. You may have already owned it. Remember, to open a collar strategy, we don't actually have to buy the shares at the exact same price. We can, at the same regard, have owned these and then open the collar subsequently. In this situation, a June $23 strike call, let's just say, was paying 55 cents on the bid. So we get a 55-cent credit for selling that call. In the same regard, so that we have upside from 21.25 up to $23. In the same regard, to buy a $21 strike put, which under all circumstances or for the next 3 months guarantees us to be able to sell the stock at $21, that was costing $1.15. So that means if we bought the stock at 21.25, collected 55-cent income, but paid $1.15, that created an adjusted cost base on the stock at $21.85. So now what we have is a break-even of $21.85, where we're guaranteed to sell the stock at 21, and therefore our maximum loss is limited to 85 cents.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.